Well, bond traders are betting on a Fed-led recession later this year, and investors are now wondering where to put their money in anticipation of an economic slowdown. Now, is the rally in tech a safe bet, or should you take your profits and move on to another sector? Joining us now is Brian Vendig, MJP Wealth Advisors President, to give us his take here. So, obviously, depending on whether or not you think we are already in a recession or heading for one or a hard or soft landing, how do you position yourself for this sort of environment?
Good morning, Rochelle. I think that obviously is the critical question of where is this all going to go? Because there are so many conflicting variables right now. And I think in the short term, what we're seeing in some of the forward-looking indicators is the economy slowing. And the answer is we think yes. We've seen some higher claims data come in from unemployment over the last couple of weeks that show the 4-week average increasing. We're seeing that spending from the consumer is still occurring and is maintaining current levels, as we've seen with retail sales recently, but we see debt levels are increasing. And I think the other part too is that with inflation coming down, as we've seen month over month quite consistently, the question is, can companies still maintain profits and margin in this environment? And is there a lower likelihood they can pass that price along? And so as a result, around the corner, we have July earnings. And with that being said, I think it's a really good test to see the quality of earnings and the fundamentals. Do they support these valuations? So from a positioning perspective, I think you need to assess those fundamentals before you continue on with this AI frenzy that has lifted the markets higher this year, and look for some other areas of the market that haven't participated in the bounce back. And at the same point in time, I think with interest rates being maintained and then, as we know now, increasing over the balance of the year, I still think fixed income and different parts of the yield curve do look attractive over the next couple of years for investors.
Because it can be tough. I mean, we're seeing the major indices shrugging off the Fed's warnings here. Bonds telling a very different story. Treasuries telling a very different story. So what do you chalk that up to then, if you have this sort of these two different directions that the markets and the bonds are going in?
Well, I mean, I think that's been the classic case between bond investors versus equity investors. Fixed income investors are a little bit more focused on what's going on with some of the macroeconomic as well as economic indicators. And equity investors are looking at what makes sense to pay for a premium or a multiple on growth or cash flows in the future. And I think the point that I want to point out to the audience is the fact that right now, the multiple that's being put on sales from technology companies start to rival levels that we saw back in the late 1990s, specifically 1999 into 2000. So again, does the fundamentals of those companies support those valuations moving forward, knowing that interest rates are still going to go up? And what I'm trying to say is possibly not, that we should probably expect some sort of pullback from the mega cap tech perspective over the next couple of months, because there's about 490 companies that have not participated in this market. And I think as the economy continues to slow, those companies probably will get a bid. On the fixed income side, as inflation continues to come down, and granted it's coming down on a slower pace than expected, we should expect interest rates to come down. And if interest rates come down, bond prices will go up. And that's our view over the next 12 months or so.
And you mentioned the 90s there, so of course we think the tech bubble. Are we seeing then indications that we might see a repeat of that, or will this be different?
That's a great question, Rochelle. I'm not trying to create the fear factor that we're going into a bubble. I think what we're dealing with right now is a frenzy. I think some in the marketplace have also called it a mania. I think, when we came into this year off of a really difficult last year, and the NASDAQ and large tech companies obviously went down the most, they had an opportunity to rebound a little bit faster. But then when you started talking about innovation and where things could go with AI and that perspective, I think investors jumped on board because of these conflicting variables. They're a little confused where to allocate assets in this environment. I think moving forward, things will come back to the norm. This disparity that we've seen in growth stocks performance this year versus value stocks academically usually does not hold. And we believe that over time, as the economy slows, you'll start to see more of a bid for some of the cyclical areas of the market, like industrials, like infrastructure plays, but also small cap stocks have also been disproportionately traded down this year due to some of the concerns going on in the financial sector. So I think there are some opportunities, but over the next couple of months, expect volatility to stay elevated. And once we get through July earnings, I think that will be a test to say, do these earnings estimates make sense for the balance of the year in 2024? And if the answer is yes, then I think there'll be some optimism in the market, and we should expect markets to grind higher over the next 12 months or so.
Because it can be tough for investors who've had all this cash on the sidelines and have this fear of missing out. But so then we've seen some of these projections for where the S&P 500 could head, some in the 4,500 range. Where do you gauge it for the end of the year?
Well, as I was implying before, I think over the next couple of months, we're going to stay in this range because the market's going to test valuations to support the price that things are trading at. I think over the balance of the year into next year, if those earnings outlooks do hold for double-digit earnings to rebound in 2024, then I definitely expect the market to appreciate from levels that we're seeing from 4,000 and above. I think there's definitely some support levels that are in there right now below 4,000 in case those valuations are not justified by earnings. And as a result, I think any major pullback over the second half of this year probably would make sense to be an opportunity, Rochelle, as you said, for those investors sitting on the sidelines, probably to come back into the market.
Well, we'll certainly see if they heed that advice. A big thank you. Appreciate your insights, Brian Vendig there, MJP Wealth Advisors President. Thank you for your time.